Hello, welcome to Any Answers Answered for January 2020. Happy New Year to all of you. Hopefully you have time to catch up on this particular advice in the midst of all of the tax returns, no doubt, on your desk. Two questions, as ever, that we're going to have a look at. The first is a very hot topic at the moment, relates to pensions, and has been asked by Timothy. I do wonder if, in fact...
Not me.
He's asking himself questions now. Pension savings charge is the question. The client has net employment income of around £600,000 and has paid £40,968 net into a registered occupational scheme. Basic rate band extended by the gross amount. The annual contribution allowance will taper down to £10,000, of course, because of this person's earnings. And then Timothy in this example says, so the charge on the pensions is this amount, net contribution minus the £10,000 allowance at 45%. Is that right, is effectively what he's saying?
No, it's not right. And there have not been that many postings in answer to this question, but I'm afraid they don't, any of them, give the right answer either. And this is a measure of how complicated this area is. So let's try to keep it simple. The taxpayer clearly has income in excess of the threshold income, which has a limit of 110,000 and the adjusted income of 150,000, which feed into the taper of the annual allowance. So there is a correct analysis to the extent that the annual allowance in this case is limited to 10,000, and not surprisingly there's no brought forward allowance. So what happens if you have a net contribution of 40,000 that grosses up, of course, to 50,000?
Okay.
Right again, Timothy, that the 50,000 then extends your basic rate band. So that's the way in which you get effective additional relief. You'll have paid it net and got the basic rate relief at source.
Also worth pointing out that at 50, it doesn't matter whether his salary is below 150 or not. At 50,000, he's over 40. And therefore, we're definitely going to be into the idea of a charge of some sort.
Exactly.
The fact this guy has income of in excess of 600,000, we're definitely going to be having quite a large charge of some sort.
Yes, at 50,000 gross, there would, against the standard allowance, be an excess of 10. But here, we have an excess of 50 over 10, which is 40. So we've got a 40,000 excess. Now, this is where the questioner goes wrong. That's the figure, the 40,000 excess here, that you then have to put in box 10 of page 4 of the additional information pages. And that will then be taxed at the taxpayer's marginal tax rate, which in this case clearly is 45%. So the tax liability on the 40 grand excess contribution will be 45% or £18,000. Now, what Timothy's done is work out tax on the net excess. He's taken the excess by taking the net premium less 10,000, and he's then, even worse, thought that you can deduct from the tax on the net excess the basic rate, which would be getting double relief instead of clawing it back. So whereas he comes up with a figure of just over 3.5 grand as the additional tax liability, the correct answer is that, rounding the figures roughly, it's going to be 45% of 40 grand. In other words, an additional tax charge of 18,000. So a good example of how care needs to be taken in looking at these figures. Many agents are unfamiliar with this. It's a problem that's just emerging in the 18-19 tax year and is going to continue unless the Chancellor decides to change the pension rules yet again.
Who knows? So the point is, we take the gross figure, deduct from that whatever was our allowance for the year, whether it be 40 or 10 or somewhere between the two. That's then multiplied by 45% to work out the excess. The end. There is then no basic rate. Or
the easy bit of all of this is that the figure that goes onto the tax return for the annual allowance excess charge will be total pension inputs, gross, in this case it's the 50 odd grand, less available allowance, which could be tapered, could have brought forward, etc. But in this case it's simple, it's 10. So it's 50 less 10 is 40. Pay tax on that at your marginal rate.
Yep.
That's the simple bit. The difficult bit is getting the background figures.
Good stuff. And a second question this month relates to asked by SA 2016. I'm not sure if that was just when they started and it was the first thing written on their desk that they saw. Minors as shareholders, are they missing something? And I think the answer is yes, they are. the question is, I've just taken on a client who had previously had an accountant who had structured the affairs that all of the children of the shareholders were also shareholders. These children range apparently from 3 years old to 16 years old. The poster, SA 2016, says, "I have always been of the understanding this was not possible, or although it may be possible, there was no tax savings because the dividends are then reassessed on the parent." We are into settlement legislation, and we're into the £100 rule and all that sort of thing, aren't we? The answer is they are missing something.
I'm afraid so. And the parental settlement rules, you mentioned the £100, if income of a minor unmarried child derives from its parent, the income is taxed on the parent, not the child, unless it does not exceed £100. Now, what then is the underlying reason for this arrangement? One of the, and of course it's a big four firm that's advised on it, so surely they're going to get this right. Well, one of the respondents suggests that it may be that the grandparents funded the shares acquired by the minor children. But I'm afraid that would not assist. And there was an accountant by the name of Graham Wilding who tried that one on, and that was the Butler and Wilding case, and more recently I forget the name. But the point there is that settlement, as in parental settlement, is very widely defined, and assuming that the parents are the controlling director shareholders, they're the ones that generate the profit in the company, effectively. They're the ones that vote dividends. And even if the grandparents paid for the shares, the parents' involvement is sufficient for it to be a parental settlement. So any dividends that are paid out at the moment would be taxed on the parents.
And so just to clarify that point, so if the grandparents, because people will be thinking this as they watch, but if the grandparents gave the money to the grandchildren and the grandchildren then used the money to buy the shares, that still doesn't get you around the problem because it's the parents' company.
Yeah. Now, here's another of the answers. If the shares were given by the parents, then the dividends would still be taxable on the parents. However, if the children were genuinely founding shareholders, did a trust pay for their shares? That might be different. No, it wouldn't.
No, it's not.
No, afraid not. But then one of them says, my money's on them using it to pay a parental liability, school fees perchance. And in reply to that, somebody says, I had a conversation with Giles at PTP about this a year or two ago. He suggested that if the money was used for something relating to the child, school fees, etc., then it wouldn't be taxable on the parent. Well, I very much hope you didn't suggest that.
I very much definitely did not.
No, I thought not. So perhaps we should post a reply to that effect.
I will tell you exactly what I would have said.
Yeah.
So the point is that if it was the grandparents' company and they gave shares to their grandchildren, then the rules are different. If it is the grandparents' company.
Absolutely.
What I
also, let me stop there. I have two grandchildren, 2.5-year-old, nearly 3 actually, twin granddaughters. I could transfer shares in our software company to my twin daughters, to my twin granddaughters, and that would be a grandparental settlement that would not then be taxed on my daughter, their mother.
Which is fine. And my advice is, whenever I talk about this in courses, I talk about grandparents giving shares down 2 generations, and I also talk about other things for normal expenditure out of income, which can include things like grandparents paying school fees and things like that.
Sure.
That is the only time I link the two. But
one final point I'd make here is we've got to go back and ask why, let's read the query, why did one of the big 4 firms set it up with these children as founding shareholders? Well, let's ask Jeremy Vine that question. He has a daughter the same age as my youngest child, and I think 5 years ago I learned that there's a company, Jelly Vine Productions Limited, owned, I think it was 51% by Jeremy Vine, I think it was 19% by his wife, which makes 70. The other 30%, or maybe I've got the wife and the daughter the wrong way around.
By the minor daughter.
But the daughter had it. Now, why would an 11-year-old daughter... So what's the benefit of this? Answer, in a couple of years' time, his daughter will be 18. The company has built up significant, I imagine, distributable reserves. And then the company can pay out dividends to the daughter once she's 18. And that will pay for her university fees, accommodation, buying a first flat, whatever. So I think it was very long-term planning on the part of Jeremy Vine, and I think that's what this Big Four firm was advising this company on.
Because the act of giving shares doesn't necessarily mean you have to give dividends until they reach
No, you can have different
18,
classes.
and then at
Exactly.
that point it becomes a very different question.
None of my children has ever been a shareholder in any of my businesses. So
No,
I've
absolutely
not
not.
done it myself, but Jeremy Vine has.
Hopefully useful. Hopefully 2 areas of tax that can crop up and therefore well worth considering. We wish you well with the rest of your tax returns, and once they're all done, we'll see you again for some more answers for Any Answers Answered. But for now, bye-bye.